Most investors think bathroom products are boring, and honestly, that mistake can cost you serious wealth. Look, we're all completely conditioned to chase the flashiest tech trends or the loudest market narratives out there. But today, we're taking a different approach. We are acting as financial prosecutors. We're putting an entire industry and one specific company on the stand to see if the reality actually matches the assumptions.
Welcome to The Explainer. Today, we're executing a rigorous institutional-grade destruction test on Cera Sanitaryware Ltd. We aren't here for a quick stock tip. Now, we're stress-testing this business through the lens of a massive 1,000 crore rupee allocation. To pass a framework like this, a company literally has to survive every single layer of analysis. We're talking macro, business model, management, financial forensics, and valuation. Out of dozens of listed names across multiple sectors, Cera was the exact match that survived. So let's dive into exactly why.
Part 1. The premiumization cycle. India's bathroom upgrade. To really understand Cera, you have to grasp the ground reality here. India is entering a massive structural bathroom premiumization cycle. And remember, boring is good because boring is exactly where retail attention fades and institutional alpha lives. There are three powerful forces converging to create this macro tailwind. Step 1 is urban housing expansion. As India continues to rapidly urbanize, millions of homes need toilets, faucets, and bath fittings. This isn't some optional luxury, it's basic infrastructure demand. Step 2 is income premiumization. People aren't just buying basic bathroom products anymore. They're actively buying lifestyle upgrades. And that pushes up average selling prices and creates real brand stickiness. And finally, Step 3 is the replacement cycle. These installed products naturally wear out every 7 to 15 years, which creates a recurring, highly predictable base of long-term demand.
Part 2. The commodity trap, where most players go to die.
Now, sanitary ware might sound incredibly simple, but the industry is actually brutal. It's totally plagued by unorganized, low-cost competition and real estate cyclicality. Just notice the sharp contrast in perception here. If you ask a surface-level retail investor, they're going to say, Cera just sells toilets. That is a shallow commodity trap mindset, because without a moat, these companies just become volume businesses fighting for razor-thin margins. But when you look at it from a 1,000-core institutional scale, the reality shifts entirely. We aren't buying products here. We are buying a sophisticated distribution machine paired with a brand moat and a powerful pricing engine, completely disguised as a standard factory business.
Part 3. The distribution moat, building the defenses. So, how exactly does Cera survive this local competition and avoid that deadly commodity trap? Well, they've built an incredible cross-sell flywheel. It's practically a step-by-step masterclass in capturing wallet share. It all starts with the sanitary ware, things like wash basins and water closets. That acts as the brand anchor. Design really matters to buyers, so this is what builds the initial trust. Once a dealer successfully sells that anchor, the flywheel starts spinning right into faucets and bath fittings. Those items have much faster inventory turns and higher repeat demand. They are the true margin engine of the operation. From there, it becomes an incredibly easy cross-sell into accessories and tiles to expand the overall basket size. The brutal insight here is that a customer doesn't just wake up and buy a toilet, they buy an entire bathroom ecosystem.
And backing up that entire flywheel are the core pillars of their economic moat. First off, they have a massive, wide national dealer network. When your dealer network is that entrenched, competitor products literally struggle just to get shelf space. Second is their positioning. They sit right at affordable premium. They aren't alienating buyers with ultra-luxury pricing, but they aren't fighting in the low-end dirt either. They are in the exact sweet spot that India's rising middle class is upgrading into, which naturally lowers price sensitivity. And third, and honestly, this is absolutely crucial, they use asset-light manufacturing. By sourcing a huge chunk of their products through partners, they dramatically lower their fixed costs and capex burden in what is traditionally a very heavy industry. This is exactly what lets them scale their product lines so rapidly.
Part 4. Financial forensics. The institutional destruction test.
Okay, so management passed the business model test, but we always have to assume that numbers can lie and profits can be engineered. At the end of the day, only cash matters. In our destruction test, we audit the financials aggressively. We're looking for a return on capital employed, ROCE, and a return on equity, ROE, that consistently sit above 20%. And Cera absolutely delivers this elite greater than 20% metric. Now, we also have to test this to ensure that high ROE isn't just a mirage created by dangerous debt leverage. Since Cera has a highly conservative, incredibly debt-light balance sheet, we can confidently confirm that this high return comes from pure, unadulterated business quality. It proves their structural economics are rock solid.
The next hurdle is the margins. We want an operating profit margin, or OPM, and a net profit margin, NPM, above 20%. And let me be totally clear here. Sustaining a 20% operating margin in consumer building materials across different market cycles is absurdly difficult. It is a massive flashing neon sign of real pricing power. Their brand premium, their strategic product mix, and that asset-light sourcing model we talked about are generating durable structural margins. These aren't just temporary one-off spikes.
But here is the thing. Even with elite economics, you absolutely cannot pay a stupid price. A great company bought at the wrong price equals a bad investment, period. So we use the PEG ratio, price to earnings growth, and our hard, non-negotiable rule is a PEG of less than 1. Cera's valuation recognizes its high quality, but it definitely isn't sitting in extreme bubble-level euphoria. The expected earnings growth actually justifies the valuation multiple. This is the exact hurdle where so many quality compounders fail the test, but Cera survives it.
Now, let's run through the institutional scorecard for our mandatory governance and cash checks. First, we test cash flow from operations against EBITDA to see if those stated earnings are actually turning into real, tangible cash in the bank. The verdict? Strong conversion. Next, debt to equity. As we mentioned, highly conservative and light. Then we review the dividend policy. Does management actually respect minority shareholders? Yes, they have a balanced payout. They aren't bleeding the business dry, but they aren't hoarding cash either. Finally, we comb through for any extraordinary items or signs of earnings manipulation. The verdict there is totally clean. No sudden weird tax irregularities or random margin spikes to worry about.
We also need to run realistic growth expectations. We aren't going to sit here and assume fantasy numbers. Let's anchor right on the base case. Assuming a 15 to 18% compound annual growth rate in both sales and profit after tax, or PAT, we can estimate an 18 to 24% stock CAGR. And honestly, that is highly solid compounding wealth creation. Now, in a bull case, where a massive housing upcycle really accelerates premiumization, a 28 to 32% stock CAGR is definitely possible. But the beauty is, even in a bear case where there's a real estate slowdown, the downside is relatively protected, hovering around that 8 to 15% range.
To completely wrap up the forensics, we rapidly audit the last few mandatory metrics. The PE ratio relative to the industry PE is currently at a premium, but just like we saw with the PEG ratio, it is totally justified by the sheer cash flow and growth profile. The market cap sits safely below our absolute ceiling of 1 lot crore, and when looking at the shareholding pattern, there is very high promoter skin in the game. For institutions, this is a massive trust signal. It shows meaningful ownership in absolutely no obvious pledge stress. So it passes every single layer of the audit.
Part 5. Thesis breakers. Non-negotiable exit triggers. Now, listen closely, because this is where most investors become incredibly dangerous to their own portfolios. They fall in love with a stock and completely ignore the cracks. We don't do that. Falling in love is exactly how capital gets destroyed. These right here are our strict alert red thesis breakers. If ROCE or OPM drops below 20% for any sustained period, the thesis is broken. If operating cash flow permanently diverges from EBITDA, meaning those profits are no longer turning into actual cash, we exit. If the PEG ratio exceeds 1 off the back of irrational price spikes rather than real earnings growth, or if management repeatedly misses their own guidance, we pull the capital. It's completely non-negotiable.
Part 6. The Consumer Compounder. The 1,000 crore playbook. So the industry, the business model, the management, the financials, and the valuation all passed the test. How do we actually deploy the capital? Institutions never just dump 1,000 crores in a blind, lump sum chunk. It requires a disciplined, phased allocation playbook. Phase 1 is a 250 crore test tranche to validate the thesis with real capital, closely watching for dealer expansion and margin stability. Phase 2 is another 250 crore confirmation tranche, which is deployed only if revenue growth and margins stay firmly above our targets. And finally, Phase 3 is a 500 crore scale-up, executed only upon continued thesis validation and deeply healthy working capital. You only ever average up on proven execution. And this brings us right to our final verdict. What looks from the outside like a boring factory that just sells toilets is actually a highly efficient, capital-light, cash-generating machine. It is a true consumer brand distribution moat, hitting completely inside a boring category. Retail investors will routinely ignore boring compounders like this because they just aren't sexy. But institutional alpha, it lives right here in the boring, the measurable, and the highly profitable. Which leaves us with one final thought to chew on. The frameworks we've used in this explainer today are what separate the gamblers from the actual wealth builders. So I have to ask,
Are you ready to stop chasing story stocks and start auditing compounding machines? The real wealth in the market isn't found by blindly following the crowd. It's found by rigorously testing the numbers until only the undeniable truth remains. Keep questioning, keep auditing, and we'll see you in the next explainer.